Trump's tariff bombshell rocks markets and CEOs are panicking. I'm Steve Van Metre, and for the American worker, the unthinkable is coming, because when chaos explodes at the top, well, as you're about to see, it means the labor market is about to tank. Stay tuned. Plus, we have a sponsor for today's show. I'd like to welcome Quarry back. You can find them on the NASDAQ under symbol SKYQ, and they're an eco-friendly company that repurposes waste asphalt shingles into valuable products, promoting sustainability and reducing landfill waste in the roofing industry. And based on their recent press releases, you'll see why the sky is the limit for Quarry stock. Stay tuned to the end of the show, or check out the pinned comment or description for more information. Now let's over to Bloomberg, where we picked today's story with the headline: as Trump to address top CEOs who are panicking as their stock price plunges. They're worried about the economy, and for good reason. And this is what I'm going to tell you is about to happen, is Trump is going to try to reassure these CEOs. He has one major objective. I'm going to tell you what that is in a moment, because this presidential win had initially triggered a wave of optimism from banking leaders, but markets have been less certain recently about Trump's approach, jolted by tariffs and emerging concerns about an economic slowdown. And if you're worried about an economic slowdown, I want you to hit that like button and comment below. Are you excited about what's coming? Are you worried about it? Can you handle the pain? Because he said last week there may be an adjustment period as tariffs take effect. And this is what he's going to try to do with these CEOs. He's going to try to calm their fears, because when chaos starts at the top, when demand starts to go down, when stock prices fall, as you're about to see, the response from CEOs is they're going to cut hours, but even worse, they're going to cut jobs. And this is something that Trump does not want, because once the labor market spirals out of control, there's virtually nothing that can stop it. And the evidence is clear as we turn to this headline: is Kohl's, Dick's added to retail worries with weak outlooks. And remember, the outlook for this year was supposed to be great. Everybody was excited that the U.S. consumer was pent up from the election. They were going to come out and spend big, and they did over the holidays, because they were front-running tariffs. And then all of a sudden, what are we seeing? Demand in the new year plunge, and that means jobs going with it. Trump doesn't want that. And you can see clearly what's coming for the labor market and why Trump's calling on these CEOs. And he's going to tell them, do not lay people off. Hold steady, because good times are coming. And here's the relationship. You see stock prices go down in the early 2000s. Look what happens to the labor market. Companies start to lay off, and then they lay off big. You see that happen again going to the global financial crisis. As the market comes down, layoffs go up. You see it right around late 2018 into 2019. And look at now, you go back to 2021, you see the market came down a little bit, and CEOs didn't hesitate at first, and then they started laying off. And despite the rally in the equity markets, they haven't hired back. So what this suggests is the market looks to head down with no floor in sight. What it means, the CEOs are looking to lay people off. And the problem we have right now is the economy cannot support these workers. We already know from those on unemployment that there aren't that many jobs out there. This is a structural issue with the U.S. economy, and if more companies lay off, well, it's going to spiral out of control in a major way. And comparable sales at Kohl's are expected to drop as much as 6% this year, far exceeding projections. Dick's also disappointed with the low end of its sales forecast and earnings guidance trailing the average analyst estimates. And when demand falls and companies have cut every possible expense they can, the next thing they do is they're going to cut their biggest expense, and that's workers. And the evidence is rather clear as we turn to this chart, where we look at continued unemployment claims against real retail sales. That's shown in red on a year-over-year rate of change. And let's go back to late 1999. What do we see? Real retail sales peak. They start to slow down. And at first, it doesn't really impact the labor market, because the economy is strong enough to absorb some of these workers. But as demand continues to slow down and eventually contracts, retailers and other businesses, all up the supply chain to the manufacturers, they start laying off. You can see that happen again around 2006. There's a slowdown that began in retail sales. It continues to slow down. It doesn't hit the economy, but as inventories build and demand falls, next thing you know, American workers hit the unemployment line, and then accelerates to the upside. And the risk we face right now is we're sitting on 3 years of largely negative real retail sales, and these tariffs are not going to make it any better as prices go up. We already know households can't afford them, so that means demand is going to go down. And of course, in turn, what are we likely to see? More Americans hit the unemployment line, which is again what CEOs are likely to do and what Trump doesn't want them to do. I can guarantee you that's going to be one of the outcomes of the meeting. He's going to tell them, don't lay people off, but it's likely to happen because at Kohl's, the retailer's been making sweeping changes in an attempt to get back on track after 3 years of declining sales. And it makes sense from any business when demand is going down and sales are falling and revenues falling. Well, you've got to cut expenses. You've got to bring your expenses in line with your revenues. And well, Kohl's is running out of options because the retailer is also cutting 10% of the roles reporting to its corporate office. So you can see layoffs are coming and in a big way. And right now, what we're seeing in these tariffs, prices likely to go up. We know households can't afford them. Demand's going to go down. CEOs are panicking because, well, that means their stock and their net worth is headed lower. And retailers, including Target and Best Buy, said they may have to raise prices because of Trump's tariffs, warning various degrees of uncertainty alongside Macy's and Victoria's Secrets. And if you're frustrated with higher prices, I want you to hit that like button, drop a comment below. Is your spending declining here? I want to know. Or are you keeping pace with rising prices? Because we know the evidence of what is to come, and that is a stagflationary recession. We can see it very clearly particularly if we get a rise in continued unemployment claims or the unemployment rate. Let's take a look at the consumer price index against total incomes of production and non-supervisory employees. That one in red, both on a year-over-year rate of change. And we can go back to the late 1980s. What do we see? Prices are rising, but companies are not passing these on to their employees. And as a result, incomes start to peak against rising prices, meaning workers can't afford them. They're forced to cut back on their spending. Next thing you know, their incomes decelerate right into the 1991 recession. You see that happen right around late 1998. Prices start to rise, but despite the fact that income growth was relatively high at that time, it wasn't passed on to workers, went right into company coffers. And next thing you know, workers can't afford those higher prices. Incomes start to decelerate right into the dot-com bubble. And here's where I think we're facing now. You go back to 2006, what happens? Inflation's at a relatively low level, and next thing you know, energy prices start to surge. Consumer prices are running out of control, but wage growth doesn't pick up. It decelerates right into a financial crisis. So if you think about where we're at now and what tariffs could do, they could significantly drive U.S. consumer prices higher. The question is, can workers afford it? Well, it doesn't appear they can because income growth has stagnated over the last 18 months. It's gone virtually flat. And based on what we're seeing in the hours work data, what it suggests is more Americans are more likely to lose their job at a time inflation is heading higher. And again, remember, when CEOs panic, it means layoffs are coming because U.S. airlines are now jumping on board and they're slashing guidance as the economy and accidents spook flyers. And American Airlines and Delta issued warning shots about the U.S. economy, saying consumer spending has pulled back sharply as economic worries have ratcheted up. And keep in mind, earlier this year, they were bullish about 2025. They said Americans were going to come out and spend big on travel. And we said that wasn't likely the case because when the economy slows down and prices rise, income growth slows, what it means is there's a sacrifice households have to make because they've got to pay for rent, they've got to pay for food and energy. That means it hits the discretionary side of the economy, travel being one of them. And American on Tuesday roughly doubled its loss expectation for the first quarter, hours after Delta slashes profit guidance. And on top of that, Southwest Airlines said, hey, your bags no longer fly for free. So you can see airlines looking to either cut expenses or raise revenue in every way possible. Travel is obviously within discretionary budget in an area where consumers might look. Well, they're not going to might look, they will look to cut out if the economic fears do come to fruition. And based on what we're seeing in the University of Michigan and Conference Board surveys, it's very clear that households are unhappy with rising prices. They're not optimistic about the labor market. And if you're afraid here, I want you to hit the like button, weigh in the comments, because when we turn and look at what's going on with small businesses, you can see the panic is real. And U.S. small business optimism retreats as more shift to price hikes. That's right, small businesses are jumping on board saying, look, we're forced to raise prices here. The problem is, as you're about to see, demand is plunging. And that means for small businesses, they're going to be laying off soon too. The National Federation of Independent Business Optimism Index declined 2.1 points to 100.7 last month. Keep in mind, after the election, for small businesses, this index surged. And we said it's all about hope because in reality, people aren't spending enough to keep a lot of small businesses around. 7 of the 10 components that make up the overall index weakened, led by the steepest decline in economic outlook since March of 2022. So all of a sudden, after being super bullish, just like a lot of the big CEOs were telling the world that the U.S. consumer is going to come out and spend big, and for small businesses, they really needed this because they've been struggling. Well, what happened is people did come out and spend, and then they stopped. The share of new owners said it's a good time to expand, declined by the most since April of 2020. A gauge of capital spending plans match an almost 5-year low. And we said this when Trump came out yesterday and said, look, we're going to face an economic transition. I said one thing that businesses are going to do is they're going to cut their capital expenditures. They're going to cut their plans to expand. We're seeing that in the surveys now. And while more businesses indicated a positive investment as they assess Trump's policies, the share of firms that raised prices increased by the most since April of 2021. The largest share in nearly a year said they're planning to boost prices in coming months. So as demand goes down and as workers see their incomes fall, small businesses forced to raise prices. And what that means is they're going to have to lay off. And wait till you see the sales numbers because they're not good either. A net negative 12% of all owners reported higher nominal sales in the past 3 months, down 2 points from January. So despite the fact that they're raising prices and their optimism is plunging, well, demand for their goods and services is dropping. They're not going to be able to keep those price hikes up. They're going to turn around and be forced to cut them along with a lot of workers. But we got the JOLT survey today that said, well, of course, employers are optimistic. Well, they were back in January, as job openings rise and sign of steady demand for workers. But this goes back to January, as this is one of the most lagged surveys published by the government, indicating that available positions increased 7.74 million from a revised 7.51 million coming out of December. But the reality is there was a reason we saw that number because of all the holiday spending. Businesses were optimistic. But then something changed, and it changed in a big way, and that is demand plunge. And when you see that happen, well, we know what it means. We're going to see job losses and equity prices likely to come down. We've shown you this chart before, and it's very interesting because you can see the relationship between the broad equity market and the JOLT survey. Let's go back to 2000s, and what do we see? The JOLT survey in blue heading down right alongside the NASDAQ 100 in red. What do you see going into the global financial crisis? Job openings peak and roll over, and next thing you know, stock prices are coming down and layoffs are headed up, and we see that right now. The equity markets have been rallying, but the problem is the JOLT survey is saying the economy is going the other direction. If JOLT is right and we see a further decline in openings, what it means is likely the equity markets are going to come unravel. But as you can find out, Trump is going to tell these CEOs, you need to hold steady. You need to keep people employed because we're going through a transition. The problem is, as we already know, companies are not going to keep idle employees around. They're going to cut hours. They're going to cut jobs. And my friends, if the spiral's out of control, we could be facing a next financial crisis. But one thing we are bullish on, and that is the stock for our sponsor for today's show, Quarry. You can find them on the NASDAQ under symbol SKYQ. And they're an eco-friendly company that repurposes waste asphalt shingles into valuable products, promoting sustainability and reducing landfill waste in the roofing industry. And they're an integrated energy solutions company with focused on revolutionizing the waste asphalt shingle recycling industry while promoting sustainability by reducing landfill waste and emissions. According to a 2018 EPA report, 15 billion tons of asphalt shingles are dumped into landfills annually, equivalent to 22 million barrels of oil, with an average North American home generating 2 to 3 tons of tear-off waste. These shingles can take 300 to 500 years to decompose, leaching harmful toxins into soil and water, contributing to an estimated 700 million tons of asphalt shingles in landfills since the 1960s. The EcoSolid technology used in shingle extraction boasts a material recovery rate of up to 95%, recycling 99% of its solvent and recovering 99% of hydrocarbons. The process involves grinding waste asphalt shingles, mixing them with a solvent to create a slurry that dissolves bitumen, and then using the heat to separate and store the bitumen while capturing the solvent for reuse, with remaining solids sorted and cleaned for the market. A key advantage of our business model is we earn tipping fees for accepting waste asphalt shingles, which range from $45 to $150 per ton and are expected to cover most of the processing costs. With the average tipping fee in Southern California at $94 per ton and national fees starting at $54 with an annual growth of 8%, nearly all revenue from recovered products contributes directly to their bottom line. And as the EPA and regional governments move toward banning landfill shingle disposal, Sky Quarry is poised to become one of the few viable options for shingle waste disposal. And their position for success through rapid scalability and growth, bolstered by its acquisition of Foreland Refining Corporation, which enhances its capabilities in the oil and energy sectors. And they're in the process of establishing smaller self-contained facilities nationwide that receive and process asphalt shingle waste in areas with largest concentration of material and have the highest tipping fees. And let's take a look at some of the recent press releases, because Sky Quarry plans to roll out modular asphalt shingle recycling units to enhance its capabilities in processing waste asphalt shingles and producing sellable byproducts like sand and granules for local markets. The company aims to establish these facilities near densely populated areas and regions with high tipping fees, while also developing extraction units for localized oil recovery. The initiative is positioned as a sustainable solution in response to increased landfill disposal mandates and aims to promote economic growth and environmental benefits. RB Residential has signed a letter of intent with Sky Quarry to collaborate on sustainable practices within the roofing industry, focusing on integrating eco-friendly solutions. This partnership aims to leverage Sky Quarry's innovative recycling technology to utilize repurposed waste asphalt shingles and RB Residential's roofing services, enhancing their commitment to environmental stewardship. Both companies view this collaboration as a significant step toward revolutionizing the roofing industry through sustainable and innovative practices. And you can see why, based on Sky Quarry's latest press releases, that they're poised to take the market by storm, and we think sky's the limit for their stock. Again, you can find them on the NASDAQ under symbol SKYQ. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.